You see here, it finally happened. And so maybe, just maybe, this might be the last year we have to do this presentation. So that would be pretty exciting, I think, for everyone. For those of you that are in your food coma right now after lunch, I'm sure this topic is going to be what wakes you back up and gets you excited for the rest of the afternoon. Unfortunately, after this is a break in taxes, so that might put you back under too, but we shall see. Anyways, thank you, Will. Good job. Let's jump into some leases. All right, so to be completely honest, there's a lot of slides here, and we have a number of slides that we may skip over here. There's a lot of information. A lot of this, frankly, is repeats from previous years. But I did add in some new sections involving, I'll say, more of a practical application, some implementation of this actual guidance, which is what we're really going to primarily focus on. So I don't think we all need to realize that this is actually applicable now for all you calendar year end 22ers. For those of you with fiscal year ends, it's coming up. You're in the middle of it at this point. It's going to hit whenever you hit your fiscal year end coming up in 2023. All right. As you can see, part of why this ASU has taken so long to come to fruition, not only is COVID and the fact that a lot of people probably didn't actually want to do it, but there's been 11 different ASUs assigned to this, some of which due to delaying the start of it, other ones doing practical expedience and other guidance updates, especially as the publicly traded companies adopted this and ran into the various snafus that they did with the adoption process. So this has been a long time in coming, but you know, it's starting now. So we're actually going to skip ahead here a couple of slides because a lot of this, frankly, are repeats from what we've talked about for the last couple of years, and we're going to come up to time to adopt now what. So this is really where I want to spend a lot of our time here today. So really, over the last few months, we've talked with a number of clients, helped them adopt this ASU, and we continue to work with a lot of our clients on it. And, you know, really have seen kind of a multi-step process in order to do this. And so I wanted to share some of the best practices that we have, and we'll delve into some of the guidance as we're talking through it as well. But, you know, this is kind of, you know, what I'm looking at is how do we actually make this ASU come to fruition? So really step one here is we need to create an adoption plan. And what do we mean by an adoption plan? All right. Now, ultimately, this is your accounting memo. This is the guide that you want to put down as to how you're going, all things associated with 842 and how your organization is going to deal with it and adopt it and apply it and all those fun things. The three big categories that you really need to consider as far as an adoption plan are what are the practical expedients that are going to be applied? What's the discount rate methodology? And are there any groups or individual leases that can be excluded? And we're going to delve into all three of these buckets because there's a certain amount to uncover in each one of them. So talk about first here the practical expedients. As you can see here, there's 8 different practical expedients, actually 11 or 10, I guess, but one of them it's a 3-for-1 kind of deal. So we're going to take a minute here and talk through the different practical expedients that are available to you. These practical expedients are designed to try to hopefully make ease implementation a little bit, make it a little less cumbersome and burdensome for you. And I think honestly, a lot of them are pretty helpful in general and are probably good things to consider applying. So to delve into these here, one of the practical expedients, first one is no need to separate non-lease components from lease components. Whenever you have something like a real estate lease, like a office building that you're renting out, it's pretty easy to tell what's the lease versus non-lease components. Non-lease would be like CAM, utilities, real estate taxes that you might owe. Lease component is the monthly lease payment that you have. Pretty easy to differentiate between the two. However, there are times whenever you might have a contract that might have lease and non-lease components as part of it, and it can be difficult to differentiate what's lease, what isn't. This practical expedient allows you to avoid the headache of trying to differentiate the two and just lump it all in as lease. And so if you're in one of those situations, this can be a great one to apply to your organization and allow you to have a little less of a headache trying to figure out what goes where. Let me put in a caveat here. Pretty much everything we're going to talk about is from the lessee side of things as opposed to the lessor, except for pretty much this next bullet point here. And the fact of the matter is, as most of you probably know by now, this guidance is primarily designed to update how lessees are dealing with their accounting for leases. Putting the operating leases on the balance sheet was really the impetus for most of this guidance. The rest of it, on the lessor side, it was really just bringing the guidance in line with the revenue recognition 606 that came out a couple of years ago. That's the bulk of what they were trying to accomplish on the lessor side. So the bulk of it's lessee. Everything we talk about here is lessee for the most part, unless I specifically call out that it is lessor thing. So this next one here, though, actually is lessor. And it's lessors can exclude revenue and expense, sales tax, and other similar taxes assessed by the government authorities and collected for the lessor from a lessee. So basically, lessors don't need to tack in sales tax and other taxes collected on by the lessee into whatever they're doing with their on the lease side. So helpful, but nothing overly significant in general. Next one up is then they may elect to use hindsight in determining the lease term and in assessing impairment of the right-of-use asset. Again, this is on the lessee side primarily. And basically what we're talking about here is, say you have a lease and you thought you were going to be there for 5 years, ends up you're actually only there for 1. And, especially we'll talk about this later on, whenever you initially adopt this guidance, unless you adopt the one practical expedient, you actually have to apply it to whatever years you're reporting on. So for you calendar year 22ers, you theoretically need to adopt this guidance as of January 1st, 2021, as opposed to January 1st, 2022, unless you adopt that practical expedient that we'll talk about here at the end. As a result of that, if you are in a situation, you may have a lease that has 5 years of useful life left at the end of 2021 that you canceled in September of 22. Well, you can use hindsight to the fact that that you're going to cancel that lease in September of 22, that you can avoid applying 842 to that lease back in 2021. You can use hindsight in determining that. So that's pretty helpful if you need to step back like that. I would strongly suggest, though, that you adopt the last one of these practical expedients, because that'll help eliminate even some of the concerns with the hindsight piece as well. The next one is the practical expedient package. This is your 3-for-1 deal that comes with the guidance. And basically you have to adopt all 3 or you can't adopt any of them. But I don't know why you wanted to adopt all 3, being candid. So would strongly recommend it. 3 you have to adopt with this package are no need to reassess expired contracts, no need to reassess lease classifications for active leases, and no need to reassess initial direct costs. So if a contract's expired, there's no reason to go back and retroactively figure out, did it actually expire? Is there any other special terms that need to go into this? If it expired, partway into 22, do we need to reassess anything? You're done. It's expired, move on with life. Next one, no need to reassess lease classifications. If you had something as an operating lease, it doesn't matter if now it would theoretically qualify as a finance lease. It's an operating lease if you adopt this ASU. And so this alleviates some of the concern, especially at the initial adoption stage, of what you have to move around on the balance sheet. And so, again, this just makes it easier. You don't have to reinvent the wheel here. You can just keep every classification the way it was. And the last one here is no need to reassess initial direct costs. So, back whenever operating leases weren't on the balance sheet, direct costs didn't really matter. You just flushed it through your P&L and you moved on with life. There was no need to go back and assess whether or not there was direct costs that needed to build up the overall value of the lease obligation. Now, underneath 842, that's one of the many components that goes into building up the value of a lease that has to then sit on your balance sheet. And so, especially if you have older leases, and I have a client that has 30, 40-year-old leases overall because they're leasing a building or they're leasing a piece of land or something like that, going back 20 years to figure out what was spent as an initial direct cost and to see if there were any, and then how is that going to apply to the lease obligation going forward. It's crazy, and it's not worth the effort. So thankfully we have this nice little practical expedient that we can avoid that. So basically, if it was a direct cost in the past, it was expensed, it gets to stay expensed. You don't have to deal with it. So let sleeping dogs lie on that one. So that whole package does need to get adopted as a 3-for-1. Otherwise, you can't do any of it. Next one is entity is relieved from applying 842 to evaluate all existing land easements that were not previously accounted for as leases underneath 840. So basically, this all goes back to the whole mindset of, if it was treated one way in the past, You don't have to reinvent the wheel and treat it a different way now. And so if you're running into land easements that weren't previously under 840, you weren't previously treating as leases, you don't have to treat them as leases now. Now, any new ones that have that might come aboard, they likely will fall under 842 as long as they meet the various criteria to be leases. So keep that in mind. This is just for the initial implementation of it, not necessarily the go forward aspect of it. Next one, short-term lease recognition exemption by class of underlying assets. You're going to see here in a bit that any leases that are have terms of 12 months or less are determined short-term, and so they don't have to have 842 apply to them. They're excluded. They can be excluded. If you have an entire group of assets that you're typically turning relatively quickly, say you have auto leases that you're only keeping the cars for 12 or 16, maybe they have them for 16 months, but generally you're keeping for 12 months, you can exclude that entire class of assets, entire class of leases as exempt because they're determined to be short-term. The next piece is non-public companies may elect to use the risk-free rate as the discount rate. We will talk more about this, and I believe 2 slides, or actually might even be the next slide. So we will be talking about that here in actually it's the next slide, so we'll talk about that here in a second. And the last one here is an entity may elect to record a cumulative effect adjustment to the opening balance sheet of retained earnings in the year when it first adopts 842 for restating the prior year financials. This one's helpful because instead of having to retroactively apply the guidance, apply 842 to the prior year. In this case, if you were a calendar year end, December 31st, 22 year end is your audit year and your application year. Instead of having to apply this guidance back to 2021 as well, you can elect this, adjust this practical expedient, and you actually all of a sudden now you just have to apply this as of January 1st, 2022. And any sort of delta between the asset and liability that comes on the books just flows through retained earnings if there is anything. So this does make it a little bit easier. We'll talk a little bit more about this too whenever we talk about the financial statement impact of everything. That'll be coming up in a few slides, but just keep that one in mind because it will come up again. All right, so we talked about, as we're talking about developing this adoption plan, big piece obviously is the practical experience that you're going to apply, is that dictates your accounting standards that you're going to be following. Now, one of the other big pieces that you have to determine is the discount rate. And effectively, the discount rate is here to help you with your present value calculation. Obviously, the smaller the discount rate, the bigger of a number you're going to have as your asset and liability, because the discount you aren't discounting significantly. If you're using a very large interest rate or discount rate, whatever you want to call it, that's going to minimize the balance sheet impact that you're going to have. Now, according to the guidance, your rate should be whatever the implicit rate is of lease. And again, we're talking most of this from the operating lease side, the lessee operating lease side, because let's be realistic, if it's a finance lease that already has an interest rate attached to it, or you can easily calculate it because you're paying principal and interest, so it should be relatively easy to figure out what that is. Operating leases, if you have to determine the implicit rate of the lease, that can be challenging at times depending on the terms or the available information that's there. So if you can't readily determine the implicit rate of the lease, you can use the incremental borrowing rate of the company for similar financing terms. And so, there's a lot of companies, some of which we've dealt with so far, that what they've been utilizing is actually their line of credit rate, whatever their lending rate is. So if it's LIBOR plus 2% or whatever you want to call it, or whatever it ends up being, they've been utilizing that with the idea that they can utilize, that's what they could buy an asset at, or if they had to buy whatever the piece of equipment is or what have you, that they would utilize their line of credit in order to make that purchase. Or at least it's a good enough approximation and a good enough standard to follow that it's easy to apply across the board. Other companies, if they're constantly leasing and buying pieces of equipment, chances are, and financing a lot of those things, chances are they at least have a rough idea how long it takes, what kind of interest rates they have for a 5-year, a piece of equipment that's going to last for 5 or 10 years, a piece of, whatever cost to buy a building, whatever their mortgage rate is, et cetera. But if you're a small non-public company, especially that maybe you have minimal debt, you don't really have any sort of, financing, you're not really buying equipment that often, you just have a couple of operating leases and that's about it, there's a chance that you might not even have a good incremental borrowing rate for the company, let alone something that's, commensurate with actual larger financing arrangements. And so it can be very challenging, especially for non-public companies, to come up with what interest rate, what discount rate to apply. And so there is the practical expedient. They're allowed to elect to use a risk-free rate. Now, whatever the market risk rate is at the time. You can utilize that. It's easy, and it's nice because it's easy and readily determinable, which makes it great. Now, that being said, the one shortfall with this is that the risk-free rate is probably going to be extremely small, which means you're going to have probably the largest potential asset and liability on the books as a result of using the risk-free rate. Not the end of the world, because in the end they net to effectively net to zero. But ultimately, though, it is going to have the biggest financial statement impact for you if you're using such a small rate. But in the end, you need to document in your adoption plan how you're going to determine your discount rate. And this isn't something you can have different rates or different methodology for different classes of assets, but in general, you're going to want to be consistent. You can't change it. You shouldn't be changing it for every single asset that you ever purchase or ever lease along the way. Whatever your methodology is, you utilize it. Whether that's we're going to use whatever our line of credit lending rate is. That is what it is from now till the end of days, unless there's a compelling reason to change it, and you're going to use it across the board, whatever assets you're leasing. So come up with that determination. It'll help you in the long run. It's something you have to disclose anyways. Now, the other thing to keep in mind, this is more of a keep in mind sort of thing. Whenever you're applying this and you're actually trying to go through and do the calculations of all of your different ready-use assets and liabilities, and you're doing all this, remember that the rate should be at the inception of each lease, not the 842 adoption date. So if you're using your line of credit rate, don't use the line of credit rate as of 6/30/22 or 12/31/22 because you drug your feet a little bit and just started doing the guidance here at the end of the fiscal year. This needs to be at the inception of each lease. If, like talked about before, I had that client that they have these 50-year long leases, but we had to go back to 1990 and find what the prime plus rate was as of January 7th, 1990, in order to apply the correct interest rate at the inception of the lease. So there's something to keep in mind there as you're applying this. The third piece that you want to talk about in here is what gets excluded. This is probably everybody's favorite category, is what they don't have to apply 842 to. So the excluded leases, things you're allowed to exclude per the guidance are term of the lease is less than 12 months, so short-term leases, intangible assets, exploration or use of non-renewable resources, biological assets and inventory, or assets under construction. Relatively limited list. Now, I will say I'm going to talk about this one piece for just a minute, and that's the term of less than 12 months. So one of the big changes that came out of this ASU was that there was actually emphasis on the idea of what involves the term of a lease. And historically, it didn't really matter, right? Because it was sitting as a blip in the footnotes of operating leases. You threw in what your future repayment schedule was for the next 5 years, or your future payment schedule was for the next 5 years, and that was it. The emphasis now on the operating lease, because it can impact the balance sheet so significantly, is what is the actual potential life of this lease. So say you have this will impact a lot of our clients, I assume, was say you have an owner who owns a building and the company leases the building from the owner and they have an annual lease with it. Well, yeah, technically it's less than 12 months, right? Or it's 12 months, so it theoretically could be excluded from applying 842. But say you just put in new leasehold improvements, retrofitted the building, spent $500,000, and it sets you up for the next 10 years. Are you really leaving it in 12 months? That leaves a huge gray area. And because of that, theoretically, according to the letter of the guidance, you're supposed to calculate what management's determination is. You're supposed to utilize what management's determination is of the remaining life of the lease. And so even though on paper it says 12 months, the reality is you might be planning on staying there for the next 10 years. And so, but as all of you I'm sure can see, there's a lot of gray there too. You could have these annual leases or a month-to-month lease, and you could say, well, yeah, because in October of every year we determine if we're going to stay for the next year. Okay, if that's your position, that's your position. As long as it's defensible, you could theoretically say it truly is an annual lease. But if all indications lean towards that you're going to be staying for the indefinite future for the next 5-10 years, you may have to put even what looks like a short-term lease on there, apply 842 to it, and have a life of 5-10 years, something like that, and assess it for impairment going forward. So there's a little bit of a challenge there on that piece. The other thing to think about as you're figuring out what leases you have to include versus exclude is who are the users of the financial statements. Ultimately, if you can have good conversations with the bank, that can go a long way to determining whether or not you need to apply 842 or if there's certain leases you can exclude. Case in point, another client of ours that we were doing work on, they had a ton of intercompany leases, not related party, but actual intercompany leases. And prior to us coming aboard and working with them, they had all the leases, they had supplemental consolidating schedules that broke out each one of the entities underneath the corporate umbrella. Well, it turns out that nobody actually needed to see those consolidating schedules. And so all those intercompany leases, we didn't have to apply 842 to, in which case we were able to skip, 50 leases, something like that, from applying it. It saved the client a ton of time and a ton of money, all because they had a conversation with the bank and had a conversation with the users of the financials where they all said, yeah, we actually don't care about the consolidating schedules. We just need the top end numbers. And so we were able to get rid of that. Now, that being said, if you're forced to show the consolidating schedules and you have intercompany leases between two subsidiaries or between a subsidiary and a parent company, there's a really good chance you're going to have to put that on, apply 842 to it and have to put it on there and eliminate it in the whole gambit. So please understand who your users are and see if you can have conversations with them to exclude that information. The other thing, frankly, and this goes a little bit beyond what you probably have to document in an adoption memo, but if you have, if the user of the financial statements are like the board or the owner of the company and that's about it, or frankly, even if it's the bank and the bank has no real interest even in 842 or doesn't care, and you can have that conversation and understand that. I would strongly recommend that you think about doing some sort of except for paragraph in your report where you're saying, we're in compliance with GAAP except for the adoption of 842. And if nobody using the financial statements cares, then that's a really good opportunity to avoid doing something that could be rather costly and time consuming overall. The other piece with this is don't forget about materiality. So if you're a $500 million company, nobody really cares about the two printer leases that you have in the office. They're just not material enough to matter. Now, that being said, the opposite side of this is there are situations where the monthly payments might be immaterial or might be insignificant enough that nobody is paying attention to it individually. But once you extend something for 5-10 years, especially if it's a term that you have to put an extension onto or something like that, those monthly immaterial payments can add up to some real dollars on the back end. And so you have to keep that in mind as you're applying this, that you have to look not only at the monthly payment and the financial impact, but you need to consider what the overall asset and liability impact are as well to the balance sheet. And that can actually be material very quickly, depending on how long these leases go. So something else to keep in mind. All right, so we have our nice adoption guidance or adoption memo written up. Next thing is coming up with a comprehensive lease list. Really take some time to think about what you got. If you have a large organization that might have multiple locations or, large enough, you have multiple decision makers in different departments, make sure you communicate with everyone and get an actual comprehensive list of all the active leases and even contracts with questionable terms that could indicate a lease. Also, make sure you have a list of your intercompany or related party leases. That way you can make an adequate assessment as to whether or not maybe you need to pay for something better on the related party side to get out of adopting 842. Or is it really necessary to adopt 842 for so many things? If you have a bunch of intercompany leases, make sure you have the right discussion there to include or exclude the intercompany activity from the listing. And so overall, you just need to make sure you're getting a good comprehensive look at that, what you're actually getting into as far as the leases go. Step 3, I'm not going to lie to you, this is going to be a shameless plug for Holsinger on this piece, is DIY versus outsourced and or using software. So to be honest with y'all, if you have one lease and that's all you're applying this to, it's like the rent for the building, you can do this in Excel. It's not the end of the world. But if you have 5, 10, 15, 100 leases, whatever, this gets very complex very fast. Think about having to have separate amortization schedules all starting at different points in time for 15 or 20 different leases. You have to aggregate all that data to figure out what your right-of-use asset and liability are, your P&L impact is across every year. Tack into the fact you can have finance and operating leases at the same time. Those all have to be segregated out into separate components. And you can quickly see how there's just a lot of moving pieces here. And maybe you all are better than me, but I always key something in wrong into Excel. It just is the way it is. And so because of that, the DIY option isn't necessarily the best situation as soon as this gets much more than a handful of leases. So if you're in that situation, I would strongly recommend you at least go out and try to purchase a software or find some sort of outside reporting package that you can utilize. Something else that you need to consider with this, the DIY option we'll talk about here in a minute, is if you don't have some sort of software or DIY piece, there's a really good chance that writing the financial statements is going to be a real challenge for you as well, because there's a lot of disclosure information that you need to aggregate. And we'll talk about that here in a second. And frankly, here's the shameless plug for Holsinger. You can also outsource this information. The reality is a lot of people out there, if they have 15, 20 leases, this is a huge time suck. And it's a bunch of guidance that you have to pick up on and a lot that you have to track. And a lot of times it's just a lot more cost effective and less painful to outsource it to somebody you can trust. And so, we at Holsinger have worked with a number of clients at this point implementing this and continuing to track the leases for a number of our clients, and we're happy to do it for you as well. So please reach out if you need help with that. And I would strongly recommend that you do that if you do have a lot of leases, especially if we're writing your audit report, because frankly, we're probably gonna have to put it in our system anyways, so we can generate the footnotes. All right, next up here, and we're going to be chugging through because we only got about 5 minutes left, and we're only on step 4 or 5, so we're going to make it though. Beginning balance impact. As we've mentioned already, there's a couple different ways that you can apply this. Either one, you have to apply for all years being reported, or you can adopt the guidance where you, in this case, if you're a calendar year end, you try to apply it as of 1/1/22. What's going to happen if you do it that way, adopting that practical expedient, is one, you're going to have, the ready-use asset and liability are going to pop up on your balance sheet with potential retained earnings impact. Not the biggest deal. The only thing that's really annoying about this one is you're going to have two sets of disclosures. Then you're going to have fiscal 21, the prior year, you're going to have the old 840 guidance disclosures in there. And then you're going to have for fiscal 22, you're going to have the new guidance, the 842 guidance and all those disclosures in there. So for 1 year, your footnotes are going to be about, 2 disclosures longer than you'd like to see them, but ultimately this is probably an easier approach overall because you don't have to go back and try to recreate the wheel on old leases. Then step 5 of this whole thing is your first year impact. Biggest thing what you're going to have with this is you're going to have to true up the asset and liability at year end. Let's be honest here, everybody. Nobody needs to be posting these entries every month unless you really are ambitious and want to do that. Realistically, I'd do the ready-use asset and liability true up at the end of the year. Figuring out what that, comparing it to whatever system you have to figure out what those asset and liability needs to be. And then you need to do a straight line versus actual expense adjustment as well if you have rent escalations. If you have the rent escalation, the big piece with this is be careful when you're doing this straight line versus actual. I've seen people mess this up already where they have all of their leases, their short-term leases, everything that doesn't have 842, plus all the leases that are 842 has been applied to. They have all those actual lease expenses into one expense bucket, and it's difficult if you got 50 of your 100 leases have 842 applied. We got to figure out the total expense for those 50 leases and then apply the straight line versus actual adjustment. It's much easier if you have potentially have separate GL accounts, one for your non-842 leases and one for your 842 leases. That way that expense is easier to track and do this. It is true up at the end of the year. And so whatever that delta is though, between straight line and actual flows through the ready use asset and reducing that there. So at the end of the current year impact, we'll talk about financial statement impact here very quickly. On the operating side, it's obviously the biggest piece. You have a ready-use asset and current and non-current liability pop up on the books. Straight line expense is hitting operating expense statement of cash flow. It's flowing through operating activities via net income. Change the ready-use asset and liability nets to zero. Therefore, there shouldn't be any statement of cash flow impact from those two. However, if you do have a straight line versus actual delta, that's going to cause a difference between your ready-use asset and liability, and that non-cash change there is going to pop up in your operating activities, similar to like depreciation or bad debt expense. Honestly, I think we all know how finance leases flow through. This is the same thing that it always had, just like capital leases. Disclosure wise, basically all the things that we talked about in that adoption memo need to flow into the disclosures for the financial statements themselves. And so that's why putting that adoption memo together is so important. Final last little say here on this piece is the DIY challenges. Like I said, there's a number of different components to the footnotes. This weighted average discount rate, weighted average remaining lease terms, future minimum lease payments, things like that are challenging. And so it's something to think about, that if you can't provide that information readily, or you don't want to sit there and calculate that, is a really good chance that you need to plan on outsourcing that. So that's really the end of the leases. All this stuff are some slides that frankly have been in here for the last year or two, showing some examples of disclosures from the finance and operating lease disclosures. A little bit of blurb about the lessor accounting. Frankly, there isn't much there, and the disclosures are similar, where you basically have to put a ton of information in. And again, shameless plug, you should hire us to do it, because we love helping you out and would love to work with you.